Hello and welcome. I'm delighted to have with me Joe Barenfreund from AVI. Joe, welcome.
Thank you very much for having me.
Looking forward to talking to you for a while. I think it's fair to say AVI, very interesting outfit, very interesting fund management firm. You've got lots of interesting funds, and you cover lots of things which range from Japan all the way through to value investing and everything in between. So what I thought I'd kick off with is, I suppose, the obvious question, which is that value investing. Would you regard yourselves as value investors, and is it a hard time to be a value investor?
Well, I would define ourselves as value-minded investors, but not as traditionally it may be understood.
Yeah.
So we're not necessarily looking at low P ratios and low price to books or high dividend yield companies, which is what a lot of value investors tend to focus on. For us, it's much more about the discounts to net asset value or intrinsic value in our companies. And that means that we sometimes find ways to own growth companies, but on big discounts to where they're trading directly in the market. And that's really what defines value for us.
Now that tends to lead us naturally into the territory of investment funds. You might have investments in other investment funds or venture capital vehicles or family office style vehicles. And I suppose, and I think this probably does sort of go back to the value point again, which is that value, even if you define it in a more expansive way, which you do, can be out of favor for quite some time, and it can stay cheap for longer than you can sometimes stay solvent, I suppose. And we're seeing that at the moment, actually, for instance, the investment trust market in the UK. There's lots of really good investment trusts out there. A lot of them are trading at actually enormous discounts, but they don't seem to be budging. I suppose the issue a lot of value-orientated investors face is that something can be really cheap, but where's the catalyst to closing that gap, as you say, between the intrinsic value gap between what you think is the real value of it and what the market price is? What are you looking for in that area of kind of catalysts? And we'll talk about shareholder activism maybe a little bit later, but just in the narrow sense, how do you close that intrinsic value gap and how do you get those catalysts?
Yeah. So we spend a lot of time thinking about this, and it does come down to some of the differences between us and your traditional value investor. Very often, and you highlighted the investment trust sector, very often you have investors who look at a fund, look at a company, they see a pound of assets there, they see it trading at 70 pence, and they think, great, I'll buy it.
Yep.
And then they're in a position of battling against time. They need that gap to narrow. And very often in those situations, those assets that are worth a pound are not necessarily going up in value, they could be going down. You could have a value trap situation.
Yep.
And then you've got a race against time. For us, the companies that we prefer to invest in are the companies where we see a pound of value today, but we also think you might see £1.50 in a few years' time and 2 years, £2 sometime later on. And so whilst the gap is relevant to us and it does inform us as to whether something is cheap or inefficiently priced, much of our research here at AVI is spent on understanding how that underlying £1 of value is going to grow in the next few years. And that buys us time so that we can benefit from discount narrowing. And it could be some catalyst, it could be some activism. But in the meantime, whilst we're waiting for that to play out, which doesn't always have a guarantee that it will play out, we benefit from the NAV performance, the underlying growth of that business, which is, over the long term, a key driver to our own performance.
Okay, well, I mentioned shareholder activism. I mean, one way you can close the gap is by shareholder activism, and you've been, and we'll talk separately about Japan, because I think Japan almost deserves its own discussion. But shareholder activism is one way you can do it, isn't it? But shareholder activism, it's funny actually. Shareholder activism sometimes got a bit of a bad rep from people. There's lots of kind of hedge fund buccaneers that you see in the media, and everyone's they have some big run-in with that. And there's different types of shareholder activism, isn't there? And some of it is quieter, some of it's more vocal. Talk us through the kind of shareholder activist spectrum, because I think people understand it. They get, okay, I see what's going on, but it's quite a nuanced and subtle area, isn't it? And how you actually do it.
Yeah, you're absolutely right. And it does cover a very broad range of activities. Starting from at the very basic level, as a shareholder, you're an owner of a company and you have a right to vote and you have a right to communicate with management and express your views. So at the very minimum, that's what one should look to be as a shareholder in a company. And then at the other end of the spectrum, there's a lot of people who enjoy the limelight. They enjoy making a lot of noise. They enjoy bullying target companies. We certainly don't fall at the extremes. We fall somewhere in the middle. And by that I mean that we want to act as an owner. We want to convey our views to management, and we want to sometimes pressurize or force management to follow a certain course of action. But at the same time, we recognize that certainly initially, at least, you're more likely to get a better result if you engage in a constructive, respectful manner than in a bullying, aggressive manner.
Yep.
And that's true in the UK, Europe, the US, and certainly in Japan as well.
Yep.
And that's really our modus operandi, which is to engage privately, to push for things, to sometimes be patient, but sometimes also have to be impatient, but to be very comfortable and willing to go public, and in some cases aggressively so, if we feel that the situation demands a more public, concerted effort of engagement.
How do management react to that? I mean, obviously they vary. Some are, I imagine most aren't particularly delighted, but how do managers react to that? Because that psychology aspect is quite interesting. Because presumably you also enter into a kind of weird netherworld, a kind of game theory, which is you're thinking what they're going to be thinking about you as you approach them, and it can get it can become quite fraught in many respects because. Yeah. Management, depending on their funds or companies, aren't always necessarily aligned with shareholders. I mean, that is one of the big problems. I mean, arguably in America, boards are terribly aligned with CEOs and not terribly aligned quite often with private investors. So it's culturally specific. It depends upon the board. It must be how does management react to you when you tend to turn up on their doorstep and say, well, no, we'd like to be a bit more dynamic about this.
It varies, as you can imagine, from situation to situation. And nobody wants to be told by an outsider how to run their business and what to do. In the case of, if you think about investment trusts, for example, boards are meant to be independent. They're there to look after the interests of shareholders.
Absolutely.
More often than not, we're invested in an investment trust because we like the underlying assets, as I explained in my earlier example. And that puts us in a more constructive situation, at least to start with, in that we're not beating up on a company on day one to liquidate the fund, which would be the nuclear option, if you like. Things might progress down that path and get there in the end, but certainly initially, we're trying to help the board out of a hole, a wide discount or underperforming manager, that kind of stuff, and so therefore it never really starts too badly.
Okay.
In Japan, which I know you wanted to talk about a bit more about later, but in terms of activism in Japan, again, it's designed to be quite constructive, conciliatory, and helpful. And increasingly in Japan, management teams are grappling with the undervaluation of their share prices. Yeah. And we try and present ourselves as the provider of a solution to that undervaluation. And oftentimes, whilst they may be a little bit unsure about our motives, and they're not sure whether to trust us, but certainly initially, if we can help them think about what they need to do to correct their underperforming share price, they can be quite welcoming and quite comfortable with us.
Before we go into Japan, I just want to finish on the investment trust subject. And I've been writing a lot about this. I'm worried with investment trusts in the UK that the discounts have got quite wide, pretty much across the whole spectrum, really. Even kind of mainstream equity funds quite often trading at reasonable discounts, double-digit discounts. And a lot of the kind of alternative assets are trading at much, much bigger discounts. Do you think that, I mean, there's two schools of thought on this. There's those like me who think there are some structural problems, some structural headwinds. Um, and there are those who just think it's cyclical and it's just the way it goes. Sometimes funds trade at big discounts and that's it. And then eventually interest comes back. Where do you sit on that spectrum? Do you think I mean, I'll list some of the structural headwinds that I think are kicking around. I don't think boards have been particularly attentive enough quite often. I think there's been quite a lot of systematic underperformance by some managers. And of course, there's the elephant in the room, particularly for alternative assets, rising bond yields and all that kind of stuff. So there are some structural headwinds that worry me, and quite often bid-offer spreads are too high, concentrated shareholder books. There's lots of things kicking around. Where do you sit in that debate? And I entirely understand people who turn around and go, look, we've been here before, and a couple of years later, everything's come out the other side. Where do you sit in that debate?
I think it's a bit of both. I think what we see today is buyers strike.
Yeah.
There aren't many buyers.
Yeah.
And some of the reasons behind the absence of buyers relates to market sentiment, market psychology, and some of it relates to the structural issues that the investment trust sector is grappling with. And I would add costs to the list as well, the whole debate there, and the focus of parts of the investor market on look-through costs, see-through costs.
Look-through costs, big issue, yeah.
But I think generally when we speak to institutional investors, wealth managers, retail investors, there's a lot of risk aversion.
Yeah.
There's a lot of clear frustration that a number of the investments that they held didn't perform in the way they expected them to.
Yeah.
So the diversifiers, be they alternative, supposedly uncorrelated assets or plain vanilla bond funds, didn't protect them from an equity correction. And so they've lost money on both sides, and they're just they're caught in the fog lights really at the moment, and they don't know which way to turn. And the simple answer for many of those investors is buy gilts yielding 5% and I can't go wrong.
Yeah.
And so there's a lack of interest. So yeah, as I say, it's a bit of both. It's a bit of both. And then there are what you see amongst the wealth managers in particular, the consolidation and the ever larger pools of assets that they're managing mean that the investment trust sector as a whole doesn't provide a solution to their problem, which is how to invest billions of pounds. And small trust and illiquid trust and the wide bid-offer spreads that you refer to, just put them off. It's much easier to buy an open-ended fund.
Yeah, or even an ETF now.
Yeah.
Okay, talking of a market that's having a bit of a tough time. Actually, Japan actually has had a pretty good year actually in the last year. But I mean, it's been through a rough patch for the last 10 or 20 years. It's certainly been a bit of a bear market long term. I mean, it's definitely picked up in the last year or so. Now, we've already alluded to, you've got quite a pronounced shareholder activist strategy in Japan, and with some success, with quite a few successes actually. So let's take each of those in turn. What's your overall view on China? Japan. That was a giveaway. So with the Japanese economy, the debate always seems to polarize around it's really cheap, lots of interesting companies there, lots of export companies, and lots of actually quite interesting service companies, lots of cheap stock. But then everybody slightly gets worried about China. There are a lot of export companies selling into China. Lots of concern about the macro regime, whether or not the yen will weaken, whether or not the bank, whether or not the central bank will carry on yield control, and as Japan seems to be this special case where every time it seems to do quite well, all these doubts suddenly start creeping out, and then that slightly impacts sentiment. What's your read on the kind of macro big picture stuff before we get to the shareholder activist stuff? Where do you think Japanese equities are kind of positioned at the moment?
Well, from a macro perspective, I think Japan is looking increasingly interesting. Yeah. It seems clear to us that they've conquered deflation.
Yeah.
The weak currency at a point in time 18 months ago when the world started grappling with higher food inflation and energy inflation contributed to bad inflation, I would say, in Japan. Yep. But the result of that has been that they've seen the emergence of good inflation, and wage growth in particular has come back. And certainly it's become, after 2 or 3 decades of the deflationary mire pervading the psychology in Japan. It's now much more about inflation and consumers demanding wage increases for the first time in 30, 40 years in some cases. So what you have in Japan is an economy that's growing quite healthily, an economy that's now got what we would term here as quite a comfortable, healthy level of inflation, enviable, you might add. And you've got a weak currency, and that's a complicating factor for foreign investors. And you've got lots of cheap companies. So from us, it's very.
Does the China bit worry you?
Yeah, China is an important export market. Much of our activities in Japan are focused on domestically focused companies. And the domestic economy looks to be in good shape.
And as you say, there's a lot of cheap companies. I always love talking to kind of quant-driven analysts. And I was chatting recently to Andrew Lapthorne over at SocGen, who's been looking at Japan for many years, Societe Generale. And he always jokes that when you're looking for Ben Graham value stocks, particularly kind of net companies that are actually below their net cash, there's only one place on planet Earth you find them, and that's actually in Japan. You might find them, I suppose, in bits of the biotech market, because it's got so beaten up. But Japan seems to have an enormous profusion of very cheap companies, along with some quite expensive companies. That's what people don't realise. I think there's some quite pricey companies there as well. Are Japanese equities cheap on average in aggregate?
Depends where you look. I think I'd say that if you look at the large cap part of the market, it's not obviously cheap.
No.
If you look at the small cap, where there's very limited sell side research and very little investor demand, there you're still able to find companies trading below cash in some cases, or certainly on very low EV/EBIT multiples. Amongst cash-rich companies. So there are hundreds, I would say.
Okay, right, and mostly small cap. And how did they react? Presumably that's where most of your shareholder activism is focused, or not. Correct me if I'm wrong. How did they react? I mean, you've already said that they're more constructive than I imagined, because I've always been sort of like financial journalists, always been brought up on this idea that Japanese companies react very badly to a bunch of foreigners turning up on their doorstep, telling them, jabbing their finger at them and telling them what we think we can do better. And therefore, there's always been this kind of shareholder governance story about Japan. Admittedly, when we compare it with other Asian countries, I think it's probably looking a lot better now. But that story still persisted in about Japan, which is quite insular culture, a lot of management looking after management. Is that changing? I know the government wants it to change because they've been putting a lot of pressure and they want that kind of change in corporate governance. But is it actually changing?
Absolutely. It is definitely changing. You have to remember that things in Japan take a long time to change. And we've now had 8 or 9 years since the Corporate Governance Code and the Stewardship Code were implemented under the third arrow of Abenomics, essentially. And we've seen massive changes. We've seen more and more companies adopt share buybacks, higher payout ratios, more shareholder-friendly measures. Pretty much every company now has at least 2 independent directors on their boards. And anecdotally, companies recognize that as part of the Corporate Governance Code, they have to do more for shareholder returns. They have to generate higher returns on equity, and they have to listen to what their shareholders are saying to them. And you're absolutely right that historically they didn't trust foreigners and they were very wary. And in some cases, if you go back 15, 20 years, shareholders behaved badly, by which I mean they behaved disrespectfully and they poked their fingers and told Japanese companies to give them back their cash. And a lot of the activists that have been busy over the last 5 or 6 years in Japan alongside us have learned the lessons of the past. They've learned that form of activism doesn't work in Japan. And if you're going to be successful in Japan, you have to accept their culture. You have to respect that they do things differently to perhaps the way they do things in America or Europe. But you have to, at the same time, make your point and make your argument respectfully and constructively. It helps to be a long-term investor and to try and align your interests with those. one of the things that they're most wary about is that foreigners are interested in making a quick buck at whatever cost, and leaving Japan, in a worse situation, or forcing companies to fire workers. No Japanese manager wants to do that. So if you can demonstrate that what you want is a higher share price, but it's going to be beneficial to the company, to management, to all employees, to Japan society at large, and you're not asking them to do something radical or painful, then they respond to it in a much better way.
Can you give an example? Would you point to an example of where you think that you've actually, you've achieved that real concrete corporate change?
Yeah, so we had a company we sold out a few months ago in both our global portfolio and in Japan portfolio, called Fujitech, which is one of the top 10 elevator and escalator companies. It was trading very, very cheaply relative to its international peers, and that was largely because the company had too much cash on its balance sheet, which was inefficient, and also because it had a poison pill, which prevented any interested parties from making a bid at a low price, and consequently it remained undervalued. We engaged with the company over a period of months, and ultimately we decided that we would go public with a letter and a presentation, a very detailed presentation, that really argued on a number of different areas for improvements. The first was capital efficiency, so doing something about the cash. The second was improving corporate governance, independent directors. And the third, and this was the clincher in terms of the relationship, was operational and strategic initiatives, which we felt the company should work on to improve and address some of the underperformance relative to their international peers in terms of profitability and margins, and some of the way they were running their business. And I say that was the clincher because that sets you apart from just another boring foreigner who wants a share buyback or a special dividend and wants the share price to go up and then you can sell. And this was about creating long-term value. And publishing this material publicly allowed other investors to understand our arguments, allowed them to convey those arguments to the company as well, and finally led to the company implementing a strategic review and addressing a lot of the issues that we highlighted. And as I say, we're no longer a shareholder, but when we did sell, it was sold at a price that was at a premium to where its international peers were trading, in contrast to the very big discount it was trading at when we started. And it also, interestingly, throughout this period of time, our relationship with the company stayed very positive and friendly, and they were always very interested to hear our suggestions.
And one last question, just on Japan. I remember talking to a shareholder activist probably 10, 15 years ago, and they said that actually it was a pretty lonely pursuit. They'd turn up on the shareholder register and you could hear the tumbleweed, go in front of them. Presumably that's changed as well. I mean, you've already hinted at it. Presumably there are more people like you, both international and domestic, who are happy to get together and affect change.
Yeah, we're definitely seeing more and more activists or engagement funds, both foreign and domestic. Domestic is the key here, just to highlight, because despite everything I've said about the change in attitude, at the end of the day, a Japanese company would much rather listen to a Japanese investor than a foreign investor. Yeah. And what's positive about this interest in the market is that you have increasing amounts of Japanese asset managers saying the same things that we are saying, and interested in talking to us and hearing from us, and that's hugely positive for the shift in mindset.
Joe, I think we've talked for quite a long time about a range of interesting subjects. One final question, I suppose, just going back to our investment trust thing, because a lot of our viewers will probably have a big investment trust kind of focus to what they do. One of my colleagues, Frank, who writes some stuff for Doceo as well, pointed out this week that there was the highest number of companies with a 52-week discount high, which isn't good news. Just in case everybody thinks it, 52-week high for their discount. Do you think we're at the trough of the discounts, or none of us know? It's just a finger in the air. We can only guess. And all the things that you and I have both mentioned are still lurking around, some of the headwinds and the tailwinds. Do you think that we're probably at peak discounts, or do you think it might have further to go or more pain to come?
Well, you never know how trust will perform in a sharp sell-off environment. And in that kind of environment, discounts can widen abnormally. But it certainly does feel from an investment opportunity perspective that we're seeing an increasing amount of interesting opportunities within the investment trust sector. Within AVI Global, we have now over 30% invested in the investment trust sector, which is a lot more than it's been over the last 4 or 5 years. And we think whether it's at the trough or not, it's certainly at very, very interesting levels and more interesting than it's been for a long time.
Yeah, absolutely. And I talk to more hedge funds, more non-traditional buyers of investment trusts than I've probably ever talked to before, which would tend to back up what you're saying. Joe, thank you very much. Fascinating interview. Thank you very much.
Thank you very much. Thank you for having me.